Welcome to Talk Tickers, where today we are digging into Hawaiian Electric's second quarter 2025 earnings call. Now, on the surface, this looked like a pretty clean beat, but the market's reaction, well, that tells a much more complicated story.
The headline number was core earnings per share of 20 cents for the quarter.
And that comfortably beat Wall Street's consensus estimates by about 11%. So on paper, a really solid performance.
Which brings us to the million-dollar question we really need to unpack here. With such a strong beat, why on earth did the stock sell off the next day?
All right, to solve this puzzle, let's put the official results right next to the market's reaction and see what's going on. So here's the scoreboard. That core EPS of 20 cents was a clear win against an expected 18 cents. Revenue? Well, it came in right in line with what everyone was thinking. Operationally, the utility actually performed pretty well. Higher revenues and better efficiency helped to offset those rising costs from wildfire mitigation. And right here, this is the core conflict. On one side, you have that 11% earnings surprise and a management team that sounds super confident, talking about a clear path forward. And on the other side, a 2.3% drop in the stock price, signaling that investors are still worried about something significant. And look at the conviction here. I mean, this was not a quiet drift downwards. Trading volume more than doubled its daily average, jumping from about 1.5 million shares to over 3 million. That's institutional money making a decision. That tells you these concerns are real and they are well capitalized. So, how is management responding to all that skepticism? Their playbook is all focused on one central theme: building a simpler, stronger Hawaiian Electric. It really comes down to this three-step simplification strategy. Sell the bank stake, divest the non-core energy assets, and the goal here is to just shed all the distractions, de-risk the business, and focus completely on their main job, running the core regulated utility. A huge part of their narrative centered on some major legislative victories. The governor signed bills that create a framework for a future wildfire liability cap and, get this, authorize $500 million in low-cost financing for grid hardening. These are massive de-risking events that give them a much clearer rulebook for the future.
And this quote from CEO Scott Seu, it just captures the sheer confidence on the call. This wasn't just some line in a press release. This optimistic, forward-looking tone was the dominant theme. Management is basically signaling that they truly believe they have turned a corner.
But, and there's always a but, isn't there? All this optimism builds toward the one core issue that's still weighing on the stock: financing the future and all the hurdles that still remain. On the call, management was asked directly how they plan to fund that second major wildfire settlement payment. Their answer? Debt, possibly in the form of convertible debt. Now, for investors, that word convertible is a huge key word because it raises the possibility of future dilution for existing shareholders if that debt eventually gets converted into new stock.
So this really maps out the road ahead. The next 6 to 9 months are absolutely packed with catalysts. We're going to get a crucial update on capital spending in November. That wildfire fund study in January will be a key signal. And then in early 2026, well, that's when the rubber meets the road, with the first payment due and the financing for the second payment expected to be raised.
So, let's synthesize all of this. How do we take these competing narratives and form an actionable view on Hawaiian Electric? Ultimately, this creates a classic bull versus bear setup. The bulls, they see the legislative wins and the portfolio cleanup as a clear de-risking path. The bears, however, they just can't look past that financing overhang and the execution risk that still surrounds the whole regulatory process.
Given this balance of tangible progress against some really significant future uncertainty, we are initiating coverage with a market perform rating. Management is executing. They're doing what they said they would do, but that financing question mark is just too large to ignore for now.
Now for our outrageous but plausible trade idea. If you believe in the bull case that these company-specific catalysts are going to win out, you could consider a paired trade. Go long HEI equity, but hedge it by shorting a broad utilities ETF like the XLU. This trade is designed to neutralize those sector-wide risks like interest rate moves and isolate the potential upside from HEI successfully executing its de-risking plan. It's a bet purely on HEI's recovery story outperforming its peers. And we'll leave you with this final thought to consider. Management has done an impressive job clearing the path and creating a legislative framework for the future. But with a massive financing need still on the horizon, have they truly solved the problem, or have they just pushed the final, most difficult question out to 2026?
And as always, this is not financial advice.